everybody. Mike DeSempoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, October 24th, 2025. Hope you're all having a great week. We're back again to update you on the markets and the economy. We finally got a little bit of economic data this week for the markets to react to, so that's kind of nice. We've gone almost a month now without any government-provided data on the economy and on the labor markets, right, which has left, as we've talked about, markets kind of in this void, searching around, like feeling around in the dark, if you will, looking for a catalyst, right? Waiting for a catalyst for the market to be able to react to. So we've seen that manifest in higher levels of volatility where the markets have been bumping around in a range here. And so today we finally got some data. So we'll move into that in a moment here. First, before we do, you can see on the screen here, markets performing well here today. This is your 5-day view of the market. Markets looking to notch another winning week this week, right? That'll make 2 consecutive winning weeks after we got that little sell-off there on October 10th with the reignited trade war fears between the U.S. And China. Now, we talked about on that Friday, right, that type of move down in the market, that expanded volatility, would ultimately pave the way, right, to be an upside amplifier, right? It was a very much needed flush of the system in terms of the volatility. Had been very low, right? And when it's low for long periods of time, you tend to get one of these kind of upshoot events here. So let's take a look here first. We got CPI data this morning. Government was able to get this data together, even though the shutdown has continued, or continues, I should say. And so we saw the inflation rate hit 3% for September, which came in lower than expected. And the month over month, the core CPI showed a 0.2% monthly gain, which is again below the expectations of 0.3%. So there was a lot of anxiety around this report because we've gone 6, almost 7 weeks without inflationary data. We usually get it every 4 weeks, right? And so there was concern amongst many market participants that perhaps there'd be a little bit of a buildup in inflation here that would catch everybody by surprise. That wasn't the case. Markets like what they see, and it continues to suggest that the effect, the inflationary effect of tariffs that we've heard a lot about still have yet to take hold. So that's a good sign for the markets. And it also paves the way for next week on the 29th. We have our next FOMC Fed meeting, interest rate announcement, which is largely expected to be a cut. It will be a cut. Markets are looking for a 0.25% decrease. I think that's the base case here. There's probably a 10% or so chance we get a 0.5% decrease. A report like this will certainly help that case, but a 0.25% at the very least is what is expected. So let's take a look at the markets, right? After that little scare of 2 weeks ago that got everybody's attention, markets continue to press onwards. You can really feel the market, it's almost bubbling at this level here. A consolidation of this magnitude where we really kind of went nowhere for a month at or near all-time highs is a very, very, very bullish development, folks. It suggests that we are going to see, for lack of a better term, some escape velocity here as we move higher soon, right? And so as we look ahead to next week, you have all the big tech titans reporting earnings next week, and you have a Federal Reserve meeting and interest rate decision. So after a market had basically nothing to react on for almost 5 weeks, we have a lot of catalysts lined up next week just as the market starts to peek its head into all-time highs, okay? So again, markets looking at another all-time highs close here today, and what is absolutely fascinating about this close in particular is this one is accompanied by something, probably the most anxiety for investors that we've seen in quite some time. The level of fear, and I'm just going to draw here for a moment, the level of fear, folks, that the market generated with just this move here, right, and then subsequent recovery is just phenomenal. And that tells you that these moves down, when they pack really, pack a punch, or you get good bang for your buck, where they're so successful in getting everybody off sides, that suggests that the market is gearing up, not just to move slightly higher, but to move meaningfully higher. So we expect earnings next week will come in well. That doesn't mean, every company's going to beat. If you're looking at the Mag 7, I would expect 4 or 5 of them will beat and rise on the news. 1 or 2 of them will probably miss and sell off. That's the norm. That somebody in the bunch is not going to be rewarded by the market, but we'll come back and update you next week on what we see and how that reacts. But just looking for a moment here, folks, right? Pressing the all-time high, or we're at the all-time highs, and investors are fearful. So you couldn't really ask for a better setup if you're looking for more upside in the market. We think this sets up very well. Like I said, I think that as markets start to pull away here and get to that 7,000 level on the S&P 500, that's not going to be a topping point, right? That's going to be actually an acceleration point. Let's take a look at, as all this comes together, November is almost here, right? And for all that we heard about seasonality in August and September and October, which was supposed to be bad, and it's been pretty good so far, which I think is a signal of the market itself, subtle signal about the strength to come. But November tends to be very good in the markets. We see a lot of good gains over the last 20 years, 10 years, post-election years, you name it. Screen the data however you like. Markets tend to do very well in November. So that's something that bears watching here, as the market has done well up to this point. Now we get some seasonal tailwinds, which really could push us much higher. Another thing we grabbed this week we wanted to discuss, I'll make it a little bigger. We are looking at a productivity boom. For those of you that have been following along with us, you know this is a theme. We've talked about this for quite some time. We've probably talked about this over the course of the last 2 years, that AI was going to usher in a productivity boom. Big inventions in nations tend to usher in a shift in productivity. It happens once every so couple decades, if you will. You can see electricity, right? Back in the 20s, 30s was a big driver of productivity increases. Then, of course, the advent of computers in the 90s, a big driver of productivity increase. And now here we are with transformational AI. So this will continue to drive an increase in productivity, not just individually, for us as a nation, for companies. And when companies become more productive, their bottom lines increase. And when their bottom line increases, the stock market goes higher, folks. It's really just that simple. So we'll continue to check back on how this plays out. But we are in the early innings of a transformational change and productivity shift thanks to AI. So we just talked about our individual investors. They are fearful. Let's take a look at our institutional investors. What direction do they feel the market will go in the next 6 months? 43% of them bearish on the next 6 months. So again, we continue to see a good setup here where price is at all-time highs, but sentiment is very much near the lows, and that combination is a powder keg. And what I found fascinating, this week's special question: do you think other investors are too bullish or too bearish right now? And the participants of this survey, 55%, look around and they say that they are too bullish. So they look at folks like us and folks like you, and they say, you guys are too bullish. And we like to be in the camp of the minority. And this is one of those markets that just because it is not doing what other people want it to do, instead of them adjusting, right? Adjust the sales, change the tact, they're pointing at folks like us and saying, we're too bullish. And I would say to that, we are exactly where we need to be, as we have been for quite some time. Let's take a look at next week. U.S. economic reports and Fed speakers, again with an asterisk next to that, right? Still missing a lot of these economic reports from the government. So we got nothing on Monday. Home price index on Tuesday. Consumer confidence on Tuesday, we'll get that. That's provided by University of Michigan. We'll see how the consumer feels about the future. Of course, the FOMC interest rate decision on Wednesday. Fed Chair Powell's press conference, 2:30 Wednesday. That's sure to be fireworks. Thursday, we'll get GDP, which will, again, I think the Fed will know what the GDP is before they meet on Wednesday, but we'll get that. And then next Friday, depending on if the government opens or not, we'll have some more inflationary data. So there is a fair amount of catalyst next week, but the eyes will be on the Fed, and all eyes will be on earnings reports from the biggest companies in the market. Before we wrap up, I just wanted to share a few graphics I found that I thought that would be helpful to share, right? Brian Feroldi shares a lot of these great graphics on investing. It's like investing visualized, and we got a good laugh out of some of these, but checking stock prices daily. I don't know why he's got stocks prices daily, but checking stock prices daily It's like putting a webcam in a forest to make sure the trees are growing, right? We want you to watch your stocks. We want you to be involved, but don't let the day-to-day gyrations of the market throw you off course, right? And I know none of you watching this are doing that, but there's many investors out there that are not part of our Heritage family here that are allowing day-to-day gyrations in the market to throw them off course. And the other one, which goes right along with that, right? Just a visualization. The days can feel bumpy, the years can feel a little smoother, and the decades is really where the money is made. So again, whether you're looking at it from years or decades, a long-term view is certainly one that yields the most success in markets. So we all like the updates, we all hate the down days, but when you stack them up over time, the years and beyond tend to really stack up in a positive manner for investors. So like we said before, markets continue to behave well, moving up into those all-time highs. If you have any questions about anything that matters with your money, reach out to us. We're always here to talk to you. We hope you have a great day and a great weekend, and we'll see you back next week for Heritage Insider Weekly.